a profit is something that people have requested that we go over quite a few times. So I thought we'd just take it slow, go through it again, just so everyone's on the same page. If there's anything that people feel that we still should cover at some point, we are still doing review. So please let us know via message or via question if there's something that you feel that we missed.
And I also have kind of a little surprise for you, because I have spent a little time with stock charts. And since April 15, I've been going a little crazy in the market and buying and selling. So I want to share with you the charts and when I bought it and why I bought it, and then when I sold it and why I sold it and that kind of stuff. So I am happy to open my kimono with you and share exactly what I have so that you can see, you know, kind of, it is not a recommendation. Please, whatever I have bought or not bought, I'm just using it for illustrative purposes, because you don't get to see anybody's stuff, you know. So I want you to be able to see mine and see if you feel that you can benefit from what you have, what you're looking at, okay? So you let me know if you want to see it. If not, no problem.
Also, throughout today, I will be posting the link to the folder that has the Be a Profit along with all of our other documents. So if you do miss it, the first time I post it, I'm going to keep posting it. So.
Okay, and if you don't want to be seen on camera, you know, you can turn off your camera, okay, especially because we have minors. I don't know if your parents are okay with your being on camera, so just if you don't want to be seen, just turn off your camera. That's okay. You can, I know you're there. I can still see your name. All right. Go ahead, Jonathan.
Okay, really quick before we get started, Josefina asked if we can show the app for Stock Tracker and how to use. I think we can do that, but it's going to require us to set up using one of our phones instead of our computers. So let us figure out the best way to do that so that you guys can see what we're doing but still hear us. But I think we can definitely do that next week. So I would love to do that.
Okay, I could see if I could do it now, but go ahead.
Okay.
But for Monday, how about Monday we do that? For you, Josefina de mi alma. So let me write it down.
Galaxy J7 Star, you have a question? Hello? Oh, it's not unmuting. There you go. Hello. Galaxy J7 Star, are you there? Okay. I'm going to lower your hand. If you do have a question and I just couldn't hear you or something, please either type it in a message to me or Kira or my mom, or just raise your hand again and I can do my best to answer that question for you. In the meantime, let's get going with our review for today. What I wanted to go over is Be a Profit. Now, we've done this once or twice before, but it doesn't hurt to go over it again. So without any further ado, let's take a look at what the Be a Profit means, what those numbers are that we're looking for and where we find them. So going over here.
And why we even do it? Where did it come from?
Exactly. So Be a Profit is a method of finding key investments based on their fundamentals. Fundamentals are kind of the statistics or the numbers that you look at when you want to figure out if a company is good or bad. You don't just look at how much money they make or how much money they lose. You really want to understand if their company is doing well over a longer period of time, how the company is doing compared to others in their market or within their industry, as well as you want to understand the value of that investment. Is it undervalued, which means that you may be able to get a bargain, or is it overvalued where you're paying a little bit more for a higher quality, quote unquote, quality stock? So let's go through this step by step. Take a look at
And
each one of the
also-
letters, the numbers that we're looking for, and what they actually mean. Does anyone have a stock that they want me to use as an example for all of this? Any stock that comes to mind. First
Good
one
idea.
doesn't. Zoom. All right, cool. So first thing we do is we pull up finviz.com. Finviz is going to be our go-to for most of this information. Then up here in the top left, we're going to go to search ticker, and we're going to type in the ticker symbol for Zoom, which is ZM. Don't worry, I also
Oh.
see a couple of other people posting tickers. I promise I'll do those as well. So we get this graph that gives us the information on how Zoom has done over time. The number on the far right is the closing price. So if you ever want to know what the current price of that share is, this number in yellow is the closing price that it currently closed today at. So let's go to our Be a Profit. First thing we're going to do is we're going to type in our first ticker symbol, which is going to be Zoom. Sorry, let me change the color of that so it's a little bit more readable. There we go. So we have Zoom. The first thing we're going to look at is beta. Beta is a way of comparing this stock or this whatever you're trading, equity, to the market. You want to understand how good its goods are and how bad its bads are, because many stocks will have their price change a greater deal compared, or a lot more than the market, or a lot less than the market. So beta is our number that we can look at to know how much a stock changes compared to the market. Now we use the S&P 500 as our baseline. So anything that we do, or our beta, is going to be compared to that market. So unfortunately, Zoom doesn't have a beta, so I may...
And you know why? It's because beta is calculated over the past 5 years, and they haven't been public that long.
Yeah, so let's maybe go with a ticker that has a little bit more... Yeah, let's go Amazon. I know Amazon has been around a year or two. Yeah, there we go. So let's try this again. Let's go to... that's the wrong spreadsheet. Thank you. So our beta. A beta of 1 means that the stock will change the same amount, on average, the same amount as the market. So if the market goes up 10 points, you would or goes up 1%, let's use percentages, goes up 1%, the stock you would expect to go up 1% as well. Whereas a stock that has a beta of 2 is going to go up $2 for every, or for 2% for every percent that stock goes up.
But it
Now
doesn't mean that it will do that. It just means it's done that in the past 5 years. So this is kind of
Correct.
driving, looking at the rear view mirror. This is what happened in the past. No guarantee of what's going to happen in the future.
Yeah, and that's actually, that leads me to a pretty good thing. Disclaimer, all of this information that we're looking at is looking at how a stock has done in the past. We're not fortune tellers, we're not magicians, we don't know what's going to happen in the future. So all we can do is look at the information from the past to try and give ourselves better odds in the future. So again, our beta that we are looking for is a beta of less than 2. So translating that to human speak, we want to find companies that have a beta of less than 2, or their price changes are a little bit more than the market, or comparable to the market, or less. So we don't want something that's going to be too volatile, because that means that if the market has a good day or a bad day, that stock may have a really good day or a really bad day. So we want to find something that's going to be a better investment over a longer period of time. So let's look at Amazon, shall we? Amazon has a beta of 1.32. So remember, betas above 1 mean that they change more than the market. So Amazon will have more price movement than the market on average, but it's still within our 2 range. So that's a good sign as far as we're concerned. So we're going to put in here 1.32. And if you want to check out the spreadsheet that we're using, Kira is posting a link to our Google Drive. All of our files from student to investor classes, including this one, are there. If you'd like to make your own, just go to the top of the page here to File and click on Make a Copy. And that will let you create your own table that you can use for your own investing moving forward. So let's move on. Earnings per share. Before I say what earnings per share is and go into it, what do people think the most important thing on this spreadsheet is? What is the most important metric that we look at? I mean, I may have made it a little bit too easy, but everyone, yep, exactly. Earnings per share quarter over quarter. So what that metric means is our earnings per share is the amount of profit that company made divided by the number of shares they have. Now, that will give us a number, not a percentage. So where do we get the percentage from? As some people in the chat have said, the earnings per share number that we're looking at here isn't just their normal earnings per share. We are looking at their earnings per share quarter over quarter. This number right here. Or how is the earnings per share for this stock doing for the past quarter, which for this stock would be, we would still be using quarter 4 information. Quarter 1. So we have quarter 1 2020. So this negative 29% is comparing quarter 1 of 2020 to quarter 1 of 2019. So we see that the earnings per share has gone down by 30%. Now, I'm imagining the first thing you say is, that's not a good thing, and it's not. But something we need to keep in mind is that because this is just comparing quarter 1 of 2020 to quarter 1 of 2019, we all know that quarter 1 of 2020, which is January to April, was a little bit crazier of a time than, January to March, ending March 31st, was a pretty crazy time in the market. So we have to keep that in mind when we're comparing my microphone died. We have to keep that in mind when we're comparing our earnings per share. That negative 30 is definitely cause for worry, but you have to remember the bigger story here of the entire market had a very, very bad quarter. So we would expect to see our numbers be much lower than they typically are. But nonetheless, negative 30 is well below what we usually want to see. What do we want to see? Well, our earnings per share is based on the number of shares outstanding. So let's quickly talk about that because it's not very difficult. When you take a company and you decide that you want to start selling shares of it, you take the company and you break it up into a bunch of pieces, let's say 1,000 pieces. Then you say, I'm going to keep, if we have 1,000 pieces, I'm going to keep 100 for me. I'm going to keep 100 for me, 100 for my employees, and then 900 of them I'm going to put out into the market. So our shares outstanding is the total number of shares that there are. So that's going to be that 1,000 number. Then our shares float takes away all of those shares that aren't available for people like you or like me to trade. So because we don't have access to all, for example, for Amazon, all 498 million shares, we only have access to 423 million of them. So our shares float is the number of shares that we have, us investors, have access to in order to buy and sell. So that is our supply, you could say. So going back to what we were talking about, we want to see a number for float above or below 50 million. 50 million is our golden number where we can say our earnings per share is able to be different. Now, I'm sorry I'm not doing a great job of explaining it, but let me go into
Sure.
detail here. So 423 million shares. That means that the earnings that they have per share is going to be, or the earnings that they have is divided by that number of shares. So because they have so many shares, we can be a little bit less strict about the earnings because the amount of earnings they have in total is still very large, but because they have so many shares, it's going to be slightly different because it's a lot harder for a big company to make a huge amount of money than it is for a small company to make a medium amount of money. So what that means in practice is if our float is more than 50 million shares, we want our earnings per share to be 15% or higher. That should be 16%. I don't know why it's 15. 16% or higher if our float is greater than 50 million shares. So again, if they have a track record, if they have a lot of shares, we can give them a little bit of breathing room and we can give them a chance to prove themselves elsewhere. If we don't have that 50 million, then we need to keep a little bit closer of an eye on the earnings per share. So for any share or for any stocks that have a float of less than 50 million shares, our earnings per share that we're looking for goes to 25%. So now if we have a stock of less than 50 million shares, we want our earnings per share to be greater than 25% between the current quarter and last year's quarter, the same quarter of last year. And if it is, then it gets our check mark. Of course, right now, Amazon having an earnings per share of negative 30% does not reach that mark. So now we've discussed float. I'm just going to go ahead and fill this in. For Amazon, it was 423 million shares. So a little bit above our 50 number. Now, atmosphere. Sadly, this is something that we can't get from FinViz, but it does not mean that it's impossible to get. We just need to go to another website, one that everyone here should be familiar with, Stock Charts. And then we go here and we can type in $SPX, which is going to be the S&P 500 Large Cap Index. So this is a kind of a temperature reading of the top 500 capitalization or the largest 500 companies within the stock exchange. So we would expect for the performance of the market to be very similar to the current health of these 500 companies. So in order for our atmosphere to be a green check mark, we want to see our point and figure chart for $SPX or the S&P 500 be in a column of X's, which we can see, well, funny enough, the arrow was pretty close, but right here, we can see that we are in a column of X's right now, which means for our atmosphere, we are in an uptrend, which is pretty good to me. Price to earnings, I'm going to come back to. I'm going to skip forward to return on equity. Return on equity is how much money or how much return you have for the investment that's put in. So say that I give you $10 and I say, go run a lemonade stand. Go sell lemonade using $10 to buy your lemons, to buy your sugar, to get your jug of water, to make your sign, and then see how much money you make. So your equity is that $10 that you were given. And the return on that is the profit that you were able to make using that amount of money. So if you came back to me and you said, all right, so I took all $10, I spent all $10, and I made 15. So if you made $15 from $10, your return on equity there would be 50%. So remember, return on equity is the amount of money, or is the percent increase in money that you've had from what you started with to where you are now. Or the amount of money that was put into the company. Return on equity is going to be the amount of profit you made from that money. So what that would look like for Amazon is going to be their ROE, or return on equity, right here, which is 17.8%. Carolina, yes. So for example, if you buy something at $100 and then you sell it at $115, that would be a 15% return on equity, because you take the amount of money you made or lost, divide it by the equity, or the initial money that was put in. So that would be 15 divided by 100, or 15%.
But remember, this is what has happened in the past again.
Yes. All of this is just looking at what has happened in the past. We never know what is going to happen. And if anything,
No guarantee.
the market over the course of these classes has proven that. We never know what's going to happen. Okay. Outstanding performer. Here is a way that we can compare this stock to its sector, or to the rest of kind of its partners or its family, and to the entire market. So the way that we do this is we go back to our handy dandy stock charts, when this thing wants to actually let me see my tab.
You see? See?
It covers everything. It's lovely. I love it.
You see?
Okay. So let's go take a look at stock charts, shall we? We are going to go to Charts and Tools, and we are going to go to Perf Charts. Perf Charts is going to let us list out a bunch of different stocks, or a bunch of different tickers, and be able to compare them all over a period of time. So what we're going to do is we're going to take Amazon. So we're going to do AMZN. We are going to take the S&P 500, which is our representation of the market, which is $SPX. And then we see that Amazon is in the consumer cyclical, or the consumer staples category, which means that we are going to go here, and we are going to go to our staples fund.
No, cyclical.
We don't...
Discretionary.
Cyclical, yeah, discretionary, my bad. So we would be looking at the discretionary sector, which is going to be more of your kind of service goods or luxury goods, car manufacturers, anything that it's not your toilet paper, it's not your bread and butter, it's things that you can spend a little bit more money on. So if you don't know what that is, you can just type in, for example, consumer, discretionary, and you get a whole list of these. But the easiest way to do it is type in XL, which is going to give you mostly spider funds, which are sector ETFs that are going to give you these different sectors that we want to compare. So Amazon, we said, is in the discretionary sector, which is going to be XLY we see here. So we're going to click on XLY. Now we get to see what stocks, or which of these markets or equities is performing the best over time. So this view is giving us the past 200 days, which is a very long period of time, but allows us to have some, it gives us a lot of information over how it's performed over time, but it's still a small enough time period for the information to be relevant. So what we're going to see here is if we click on Amazon in the top left, it will set Amazon to be the 0 line. So now everything that we see, all of these percentages, compare the market and the discretionary sector to Amazon. So we can see discretionary is 25% less and S&P is 26 or almost 27% less, which means that our Amazon ticker over the past 200 days has outperformed both its sector as well as the market. So for here, it would be outperforming. Now, institutional investors. What does this mean? Institutions are big companies, or as we like to call them here, they're the hippos. They are big companies that don't just invest for the fun of it or invest for a stock market competition. They invest hundreds of millions, if not billions of dollars into stocks across different markets, and they really try and use their buying power to raise prices of stocks up. So if a hippo buys a stock, think of that stock as a bathtub. There's a certain amount of water, and if a big hippo gets into that water, the water level is going to rise and rise and rise really high. And as savvy investors, what we want to do is, remember, we never can know for sure, but we can only try and predict these changes, or if the hippos are getting into the bathtub, so that we can be a little rubber ducky on top of that water. So when the hippo gets in, we go floating up. Remember, a rising tide floats all boats. That's the same for the little rubber ducky that is our investing strategies. So we want to see institutions are buying. We want to know that institutions think that these stocks are good and that there are people that, or there are big companies that are investing into this sector, or into this company. My apologies. So if we look at institutional ownership for Amazon, we see that they have an institutional ownership of almost 60%, which means of these shares that we see that are available for us to trade, 60% of those shares are owned by large banks, investment firms, or portfolio managers. So that means that there's a lot of big people, a lot of big hippos that are in this pool that want to be buying or selling Amazon. So looking back to our Be a Profit, we want to see our institutional investors above 10%, which 56.7%, what was it? 59.7% is well above our 10%. So Carolina asked, how do the hippos choose the companies they are buying? That's a really good question. It depends on the type of company. There are many portfolio companies or banks that will do what's called microtransactions or interval trading, where what they will do is they will try and buy stocks and sell them in like split seconds. We're talking maybe 10 milliseconds, 1/100th of a second, they bought and sold the share. And all they want to do is make 1 cent. If they make 1 cent per share and they do that 100,000 times in 1 minute, that's $10,000 right there. So,
and how they choose the companies is they have people that, I mean, they send people to the companies, they send people to outside of the U.S. They go and they look at the car and they kick the tires. So they have analysts, and all they do is look for possible candidates. So this group of people decides what they're going to get into, and they do it according to their rules. For example, T. Rowe Price is it's a mutual fund family that is a little more aggressive than other families. So they have their Be a Profit that they follow, okay? They have their own formulas, and they spend millions of dollars doing this. So there's a lot of money that goes behind, a lot of smart money that goes behind these purchases. That's why we use them, because these are the movers and shakers. But how they decide is they have groups of people that do nothing but this, to look for this.
Fun little story for all of you guys. There was a huge issue back in the mid 2000s and even today, where companies, they didn't just hire analysts, they hired programmers. They brought in programmers to create software and create computers that can buy and trade much faster than you or I or any human can. So they wanted to have an edge. They wanted to be able to buy things 1/100th of a second faster than their competitor. So how did they do that? They can't upgrade their internet, sadly. You can't ask for faster internet for trading stocks. But what you can do is you can move closer to the stock exchange. So that's what many companies did. They started having a buying war within Wall Street of trying to find offices closer and closer and closer to the New York Stock Exchange so that they can get the trading information that much quicker than their competitors. Because if they get in 1/100th of a second faster, that can mean millions of dollars over the course of just a few weeks.
That's so cool that you remember that.
Well, what's also really cool is there's a smaller index run from New York. I forget the name of it. But they added, there's a giant box of over 700 miles of fiber optic cable. Fiber optic is the most common way of sending information. It uses light, which is incredibly fast. But they intentionally add miles upon miles of cable because it artificially slows down, or actually manually slows down that information so that nobody gets it faster than anybody else. That information is available to everybody at the exact same time. So that has to do very little with institutional investors, but it goes to show that institutions are the people that are going to cause the prices to change. You and I don't have a lot of influence over the stock's price because we're buying and trading 1 or 2 stocks. These people are trading hundreds upon thousands of shares. So we really want to be following these institutions and trying to figure out when they are buying and when they're selling so that we can be in that little pond when the water level raises up and we can be ready to jump out when the water starts to go down. So that is institutionals. If anyone has any questions about that or anything else we've discussed thus far, please feel free to put it in chat. I am trying to keep up with the chat as much as I can, as well as Kira's got my back on that. And we can answer any questions people have live on the air.
How cool would that be, Adriana, if we could just get a bunch of us and go to the New York Stock Exchange? I went to the NASDAQ and rang the bell once. Well, I didn't get to ring the bell, but I was with the group that rang the bell. And it was very exciting to go there. You really feel the power of commerce and free enterprise when you go there. So if you go to New York, or when you go to New York, and many of you go to New York as your a trip from school, the stock exchange is definitely one place to go. Not now, it's closed.
Alrighty then. So let's go to our last number here before we come back to price.
And then we go to
earnings.
Magnolia's house. She's saying come to New York. If we go to New York, Magnolia, we're going to your house.
I'll bring the potato salad.
Well, considering we've been wanting to go to New York.
Yeah. Okay. Top dollar. What does this mean? That means that we want the price of this stock to be near to its top, if not at its top, which means that the stock is doing really well over where it currently is. So the way we do that is we say we use a 52-week high, which means what is the highest price it has reached in 52 weeks or a year. So 52 weeks is the amount of weeks in a year. So we want to find if this share is within 10% of its highest price from the previous year. So if we go to Amazon over here, we can see here our 52-week high is at negative 1.7%. We expect this number to 95% of the time, if not 99% of the time, to be a negative. The only way it would ever be a positive is if today, if the number it was reporting today is the new 52-week high. So what does negative 1.7 mean? Is that a bad thing? No, that's exactly what we want it to be. A negative number is what we expect to see because we're saying how much lower is the price right now compared to its highest point. So as long as this number is within 0 or above 0 even to negative 10%, that still meets our requirements because again, negative 1.68% just means that it's 1.6% or 1.7% below its highest price it's reached all year. So that means that for this, we can put 1.68%. So running down the list, everything that we've checked so far looks really good as far as Be a Profit is concerned, except for our earnings per share. So let's look at the last number, price to earnings ratio. Oh, we have a question in chat. How can we check how much cash and debt a company has again? Mom, unless you know a better way, the easiest way to know their cash flow is publicly traded companies are required by SEC law to publish quarterly reports, which are called 10Qs, and then 10Ks, which are their yearly reports. Those are going to give you all of the numbers that you see here on FinViz and more, because it's going to be telling you their cash flows. It's going to be giving you all of their, for example, if they're a company that owns an airplane, how much money that airplane has lost just because they've owned it. So depreciation of assets. It's going to give you everything on that company. So if you want to find any specific information, you can either call the company and request that they send you their financials, or you can go online and find their SEC filings, which is going to be in the form of 10K, K as in Karen, and 10Q as in Queen.
And also, Jonathan, if you hit on the right side there where it says statements, they get this information from the 10Qs and the 10Ks. And if you see there where it says cash flow statement and income statement, you see, don't move it from there for a sec, just leave it in income. You have an income there, what their sales are, okay, and then what their expenses are. And if you go down more, let's look for, it's in one of those three tabs where you see the, can you move it up for a sec? Where it says cash flow? Okay, cash flow. That's the money that they have on hand so that you see how much cash they have. See there, the net income, and then other assets, and go down more. More, okay, 1 second. Go down more. Okay, I see the free cash flow, $21.65 billion. So that, if you click on that little plus sign there next to the free cash flow, it's going to tell you how much is grown and what comes from yield, which is what they get as you know, just the money, earning money. And if you go a little higher where it says change in current debt, you're going to see there how much debt they have right there. Other funds, other uses, other sources, change in current debt. See right there, right there. And so you have long-term debt is 10.07 billion. And they issued very little, well, they issued $2.2 billion, not very little, but they reduced $12.34 billion in debt. So you look at the cash that they have in hand compared to the debt that they have. And this is where you find it in the, go up for a second, Jonathan. In the cash flow statement. So always just go to Finviz, hit on there. If you go to Yahoo Finance, you'll find it there. Usually it will say financials. It will say something like that, but you will have that report in all of them. And you'll get it in Morningstar. They all get it from the 10Q and 10K. It's just that they give Rapid differently right there. But if you want to get into the nitty gritties under the hood, that's where you get it. But they get it. If you want to get it from the mouth of the lion, you go to sec.gov, and they have a service called Edgar, and it's not anybody we know, but they have a service that displays all of the Q1s and the 10Qs and the 10Ks. Okay, sorry, go on.
Leo Bonnie's saying, am I having fun drawing? Yeah, I mean, come on. What is this, finance class or art class? I thought it was art class. I was here to draw.
What is this?
Leo Bonnie, I was drawing a bunch of arrows towards the statements. So
yeah, because it's really easy to miss. Before it used to say financials and in the middle, and now they just hide it there to the right. But you know, they're going to change it around on the website, and you're going to have to look for it.
Cool. Well, thank you for that. There was one question that I skipped over and I wanted to go back to really quickly. Codman asked, can you give an example of top dollar? Sure. Let me go use another company. People said Zoom earlier. I feel bad that we couldn't really do too much with that. So let's go back to Zoom. So Zoom, remember, we want our 52-week high. We want this number to be somewhere between negative 10% and above. So anything from negative 10% up to 0% and above is a good sign, because that means the price is close to, if not at, its highest price. So for Zoom Communications, we see that their 52-week high is showing a number of negative 7.51%.
Well, the price right now is 7.51% under this 52-week high. So anything there 10 or less is what we want.
Exactly. So actually, let's do a fun little test, shall we? We have a negative 7.5%.
Mm-hmm.
If we took our current number,
you're going to say.
we see that, sorry, I'm just trying to do it off screen here really quickly, and then I can pull it back up. So we see that our high, if we took this number and we multiplied, or rather, if we took this number to try and figure out what our highest price is, we can take 207, divide it by 107.51%. Or sorry, what?
You're using percentage with 100.
Well, it's showing you there that the 52-week high is 224.46. So take 224.46 minus
that's going to be easier.
Yeah, there's different ways to do this. 7.51%, and you get 207.60. And if you notice on the right there, that's the price of the share.
Mm-hmm.
See it right there on the right?
Yeah, so you can see the 52-week high right here. I was going to do it the opposite way. I was going to start with our current price and go up to the 52-week high.
Mm-hmm. But you could. You could do 207 plus 107%.
Mm-hmm. Which is what. All right, so let's go look at price to earnings, because that seems like the only thing that we haven't covered on this sheet. So price to earnings, the way that we get this is we need to compare, let's go back to Amazon. We need to compare Amazon to both the sector as well as compare it to itself. Because price to earnings is not our way of saying if something is a make or break for a purchase. It is a way of saying the value of that share. There is no right or wrong answer. There is only good answers. So what does price to earnings mean? Price to earnings is mathematically the price of all of the shares combined divided by the earnings that they have. So for example, if I maybe have a share price of $10 and for every share of my company, I made a profit of $1, our price is $10 per share, our earnings per share is $1, which means 10 divided by 1 is going to be 10. Let's use another example that may give us a little bit more of an idea. Let's say that...
And this is during the last 12 months.
Correct.
The average price during the last 12 months and the earnings during the last 12 months.
Correct. Everything we're looking at is over the past 52 weeks, correct?
52 weeks, yes.
Yep. So the way that we would figure this out is we would take their current price per share. So let's use Amazon, for example, 2483. And we divide it by the earnings per share, which is going to be 20.93. So 118. Now, if we go up here, we're going to go to, let's see, groups, if I recall correctly. We go to custom. And then here under order, we're going to go to EPS.
Yeah. P&E
Price to
ratio.
earnings. My bad. So this is going to give us the price to earnings ratio for all of the different sectors. So remember, we said that we have Amazon under the consumer discretionary or consumer cyclical category. So the P&E for this category is 29.21. So we're going to put that in for the sector price to earnings ratio. And then let's go back and let's see how this compares to what we have for Amazon. So for Amazon, we have price to earnings. Remember, we calculated it. We didn't even take this number. 118.61. We calculated 118.63. That's close enough, if you ask me. And we can compare it to the sector. Now, what this is telling us is that Amazon, compared to the rest of the sector, is overvalued, which means that people are willing to pay a lot more to own Amazon stock than they are for other shares in the same sector, so other consumer discretionary companies. So this allows us to look at this one company and say, is it worth it? Is it a value investment? Is it a bargain? Am I getting something for really cheap? Or am I spending a lot more money for it? And is it worth it? That is the ultimate question with this one, is not, is the number high enough? Is it a yes or a no? It's, is it worth it to me? And again, this is where it comes in. We don't know what will happen. All of these numbers only tell us what have happened, but many investors, myself included, would rather pay a little bit more for a high quality stock than find something that's going to be a better bargain, but may not have the same likelihood or the same level of risk, let's say.
Quality, it's really.
Exactly. I like paying for some good quality goods. So that is everything we have for Be a Profit. Does anyone have any questions or anything they would like to go over in specific for this? If not, I have one more fun thing to show everyone. Daniela has a question. Hello, Daniela.
Hi, so my question is, if a stock gives a buy price, then you check it again a couple of hours later, and it went below the buy price, is it still good to buy?
That's a really good question.
What company are you talking about?
I don't know, any company.
Okay, ideally, no, because it means, and thank God that you haven't bought it. So why would you have bought it and then have it gone down? How would you have felt? So no, if a stock hits the buy price and then it goes under the buy price, wait until that buy price is hit. And when I share with you the stuff that I have bought, you will see what this means. I'm so happy, Adriana, that you got the top dollar. Okay, it just means that it's within 10% that price of the highest price it's had. But no, I wouldn't buy it if it goes down. I would buy it if it goes up, but let me ask you a question. What kind of a window are you having to buy it? If it's $40, the buy price is $40, how high can you buy it?
Um,
10% more,
yeah.
which is what?
Um,
If you have 40, it's a 4 and a 0. Get rid of the number on the right, so get rid of the 0. So what's 10% of 40?
4,
Add 40 plus 4.
44.
So your window to buy it is between 40 and 44. If the stock buy price is 50, what's your 10% of 50?
55.
You got it. Between 50 and 55. But if it hits 50 and then it goes down to 48, don't say, oh, wow, it's on sale. It's going down for a reason. It was not a solid, convincing buy price. It was tentative. You can lose money on tentative. You can lose money anytime, but on tentative, even more. See what I mean?
Mm-hmm.
Buy it when it's getting you solid ground and when it's hitting higher than that buy price.
Okay. Thank you.
Okay? Yeah,
Thank
you're
you,
increasing
Daniela.
the odds of making money.
Awesome. Thank you so much for the question. There's a couple of questions in chat I'm going to run down really quickly. Carolina asks, in one class, Julie said it's not good to buy stocks under $10, but what if they have good fundamentals and technical?
Then you do it, honey. How much
Yeah.
is it though? Not penny stocks.
I was going to say, I think that it's not so much $10 as it is anything under $1. Anytime you get into penny stocks is where things can get a little bit more risky just because of the territory.
They're not
But-
required to do 10 Qs or 10 Ks. They're not required to do anything. So they could do whatever they want, any way they want to, and talk up a big gain, but they don't have to show the SEC any numbers. Would you want to invest in a company like that? I don't know.
I'll pass. Thank you. But if they have good fundamentals and technical, remember that there is no one way to do this. Everything we do here is finding different ways to increase our odds. Some ways you may like more than others. Some may make a lot of sense right away. Some may take a while of messing with them to really learn. But just because something doesn't meet every single requirement for our fundamental analysis does not mean that it's a bad share, just as a stock that may not meet our technical requirements 100% is a bad share either. So it really is important to take in all of the information together and use your knowledge from both technical as well as fundamental analysis to make that decision. Julie in the back.
Thank you. And also, if you check institutional holdings, you're not going to find any because institutions cannot afford to put millions of dollars into penny stocks. Imagine how many shares they would have to buy. So when you say the fundamentals are right, couldn't all be right because institutional investing isn't going to be there. The hippos don't go and eat bird food. That was a good one. I want you to laugh. That was a good one.
Someone asked, can I repeat price to earnings? Sure. So earnings is the amount of profit that a company had. It is the amount of money that they made that they can record as profit. Price is how much people like you and me are willing to pay for a share. So if the price of a share is $300, that means that I'm willing to pay $300 to buy one share of that stock. So remember that we have EPS, or earnings per share. That number is going to come in handy here because our price to earnings ratio is the price per share divided by the earnings per share. So that's how we get these two numbers here, is going to be the price of the company divided by the earnings per share of the company, and the price to earnings of the sector by the same numbers. Would GE be considered a penny stock? Let's take a look. I'm inclined to say no. They are a very well-established company that has been in the stock market since
It's a broken company at the moment, and it's really sad because it's an American institution, General Electric, but it is a broken company right now. I'm going to look for the chart.
Yeah, we can see that, well, the earnings per quarter this time was not bad, but
no,
again,
they could come back. You know, some people say it's a value move. That's what a value company is, General Electric. Okay.
Well, let's look at some more important numbers here. We can look at their 52-week high is 40% down. So we are at about 60% of its 52-week high right now, which means that we're a little down. Our earnings per share quarter over quarter is insane. Yeah, go for it.
Okay, let me show you the point and figure for this, and maybe this is why you're asking, because it did give a signal, a buy signal today. Okay, there's GE, General Electric. The price is, you know, closed at 788. Just barely making it to not be a penny stock.
We don't see anything.
I'm sorry?
Now we do.
Oh, there it is.
Okay, so here, first of all, it's on a long trend, downtrend, because it's under this red line right here. The stock price would have to go up this column of X and hit that red line in order for it to change from the red line to a blue line that would then go back and start making a blue line here. So long trend is down, short trend is up. And these two means this is what it did today. In June, it went here. In April, it went up to here. And then in April went down. May went like this and started going up. June here, and it's continuing to go up. Would I buy it? No, I would not buy it because of this here. And because if you compare it to, Jonathan, can you do the performance in stock charts, the performance chart with General Electric? And let me, you can push me off of sharing. But let me.
Sounds good. General Electric is industrials.
GE.
Yeah, I just needed to find what sector they were a part of.
That's what I was looking for you. It's industrials.
Sorry, my computer is being all sorts of weird right now. I think it's ready for the weekend more so than I am. So XLI is going to be our industrial sector. And someone actually asked before if we can go through and talk about our outstanding performer a little bit more. So let's do that really quickly, and then I'll let you get back into what you were saying, Mom. Sorry.
No, it's okay. You know what? Make the 200 days. Let's make it the last 3 months, which is 63 days.
Sounds good. So let's go 63 days.
Because it was a different world back then. Okay, here we go.
Okay, so what we're seeing here is
And hit
from
the S&P, so
63
the
days
S&P is
ago,
the 0.
from 63 days ago to today, the changes in price for all three of these all three of these equities. We have General Electric in red, the S&P 500 in green, or sorry, blue, and the industrial sector in green. So what we can do is, this is showing us right now their absolute returns. So over the past 63 days, General Electric has lost 4%, while the industrial sector has gone up 14.6, and the S&P 500 has gone up 16.3. Now, if we click here up in the top left, this will allow us to set General Electric as our 0 line. So now, if we hover over this 0 line, we can see absolutely nothing because Google doesn't like me. We can see that it's all at 0. So now everything we see on this chart is compared to General Electric. So we can see that the industrial sector outperformed General Electric by 18.62%, just as it has the S&P 500 has outperformed General Electric by 20%. Keep in mind, we can also do this for any of the other things we're looking at. So we can go to industrials, and now industrials is the 0 line, and we're looking at the S&P 500 and GE compared to that. So mess around with this. This is a really good way to not only find your ideas of outstanding leadership or
Put
outstanding
zoom
performers.
there. Oh, no, because it's not industrial. Never mind.
This is a good way to find your relative strength in terms of being able to compare a bunch of different stocks or equities over time. But really, for Be a Profit, we use it just to do our outstanding performer.
You want a leader. You want somebody, a company that's leading its sector, that is leading the market. You don't want, and GE needs to pedal a lot.
Okay, there's one last thing I would like to go through, and that is going to be the Biz Screener. This is one of the easier ways that we can take Be a Profit and apply it to a lot of stocks all at once. So how do we do this? We go through and we need to set our filters. So if we go here, we can go to Fundamental, and here's where we're going to start putting in all of our Be a Profit things. So the first thing we're going to want is institutional ownership over 10%. We are going to want our EPS growth quarter over quarter to be over 15%. Remember, for stocks with less than 50 million shares, we want it to be above 25%, but because we want to capture everything above 15%, we're going to set this to over 15. Then we're going to go to our ROE, which is, if my eyes start working, ROE, we want it to be above 15%. Then we want to go over to technical. We want our 52-week high.
Oh, you had EPS there.
No? EPS quarter over quarter.
Thank you. Sorry.
We want our 52-week high or low to be 0 to 10% below high. And we want our beta to be under 2.
And that's the top dollar.
Yeah, 52-week high is our top dollar. You do not need a subscription to set this up. The only thing you need a free account for is to be able to save these filters so that you can go back and look at them another time. So now that we've had all of this set, this will give us below only stocks that meet our requirements. So everything that we see down here are stocks or shares that have met all of our Be a Profit numbers. So if we see up here in the top left, we have 81 total stocks that meet our requirements and say, be a profit, I am the profit. And this is a great way to be able to take be a profit, put it over a bunch of stocks, and without doing a bunch of work, be able to see stocks that meet our be a profit, but don't limit your possibilities by only the stocks that you know, and save you the time by having to go check them all individually. Eleazar asks, what about sales quarter over quarter? It's not as important as be a profit, but it is important to look at companies that are increasing their sales as well.
Yes. Yes, because sometimes earnings per share, they can maneuver, they can move around those, they can play with those numbers, but sales are very easy to keep track of. And you want a company, you also want to make sure, see, everything is important, but the be a profit is the skeleton. That's what you need to know. But if I had a choice, if I were to write that book over again today, and I made up be a profit, okay, I looked it up, I looked at all of the characteristics that were common among the best stocks in the past 100 years. These were the characteristics that were in common, these parameters that you have here. But today, I would take out P&E ratio and I would put in their sales. Because it's also a telltale sign if you had, see, so you already know about the next book without, before I published the next book. So that you have, let's say you have an increase in sales of 100% and an increase in EPS of 5%. Something is wrong. If you double your sales, how could you not double your profit? Something is going on, you're mismanaging, you're wasting money somewhere, you're paying too much for inventory. That company is doing something wrong. So you want for those two numbers to be increasing. Excellent question.
I actually have one thing to add about that. Something that you need to keep, or something, I apologize, it's not you, something we all need to keep in mind about sales is sales are not representative of the cost that went into creating those sales. So for example, there's a company like Tesla. Tesla did not turn a profit until last year for the first time, but they've been in the automotive industry for almost 7-8 years. The reason is because all of their profits got immediately reinvested into more research and development for upcoming projects, or a lot of their revenue went directly into developing their super factory, which they didn't get to report as sales, but they still had to report as a loss because they invested money into it. So sales is going to be a very good indicator of how much money a company is bringing in, but oftentimes there's another story there that is how are they spending that money as well? Because you want to know that a company you're investing in is not just making a lot of money, but they're making profit, because there's a big difference between making money and making profit. And some companies, especially newer companies, may struggle with that. It's expected that within the first 18 months of creating a company and taking it public, that first 18 months is usually considered a grace period where it's expected that you turn a loss. You're not supposed to make a profit in a company until after the first 18 months, because they consider that first period investment, research, development, buying your tools, perfecting your craft, then you can start making some money.
True. And Javier asked the question, it says, what about performance? Is not important? Sure it is. Look how we measure performance. We want to buy a stock when it's within 10%. The price is within 10% of its 52-week high. That means the price has to be high. It has to perform well. And we also look at the relative strength when we're looking for a leader. We're looking for an outstanding performer. They have to beat the S&P 500 and their sector. So of course, performance is what it's all about. That's when we get paid, is when the performance goes up so that we can make money. And somebody else is asking also, Antonio, about Yahoo Finance, that they have a fair value. Let me tell you, fair value could be anything that that piece of paper takes, and it takes whatever you write down. A fair value of a share, and forget this if you remember one thing out of this class, is how much people are willing to pay for that share. And nothing better than charts will give you that. So I can tell you that's oversold, that's undervalued, that's overvalued. Great. You might say Microsoft is overvalued, but hey, people keep paying the money for it. So that's how much it's worth, how much people are willing to pay for a share.
Exactly.
And graphs is what gives you that without anybody's opinion. It's money on the table. That's why all of these numbers, if your eyes are in the back of your head, don't worry about it. Because, and that's how I found Zoom. It wasn't because of the numbers. It was because it became a leader in its industry because of what we were going through. So it became a momentum play. It became a coronavirus play. And I mean, okay, whatever play it is, it's the price is going up. I'm on it. And that's what it is. So don't fight the numbers saying, oh no, that number's not good. Plus, remember, these numbers are after the fact. This is what has been reported, and it's only reported once every 3 months. But the charts are upgraded constantly. So there you have the thumb on the pulse. You cannot buy and sell shares of stock without technical analysis, but you can buy and sell without fundamentals. And I'm sorry I wrote a book about fundamentals, but also about technicals. So you need them both. It's like playing the piano with both hands. But if you're only going to play the piano with one hand, you're going to play with your stronger hand, and that's technical. Is that contradictory? No? I'm giving you some back alley advice that you get from experience and from studying.
There's one question that someone asked that I think is a great question, and I want to go through really quickly. Somebody asked,
I want for Jonathan to answer that, Rosalba, because he doesn't know what that means either.
No clue. Technical would be point and figure, yes. So something to keep in mind is very rarely do you want to just use one or the other. It is oftentimes good to use both. So you can use point and figure to find your buy and sell signals, but you can use technical to find your companies. But someone asked, how do you find a company that has good technical but may not reach your fundamental?
You wait for it to break out.
And how do you find that?
I've given them that scan. Yeah, so, you got it, baby.
If you go to stockcharts.com and you go to charts and tools up in the top left, you can find on the bottom right here, predefined scans. And what this is going to do is it's going to give you all of our point and figure signals that we've talked about, mainly our double top breakouts, which is where our current column of X's goes above the previous column, and triple top breakouts, which are our current column of X's goes above the previous 2 columns. All of these symbols, or all of these right here, are our point and figure buy and sell signals that will give us good indications of those buy and sell signals for those stocks. Whether or not the fundamentals back up the buy signal is a different story. But if you're looking for stocks that may not meet be a profit perfectly, but you still want to find things, maybe you say, you know what, I want to look at my stocks today. I don't want to think about it. I just want to find some good investments. This is not a bad first place to look. You can go here and find stocks that are on a buy signal now, that they went on a buy signal today. Or that they've recently gone on a buy signal, and you can jump in right away for those. Again, I love information. I love trying to get as much information as I can, and I always try and use both technical and fundamental analysis when finding investments. But the beauty is, invest your way. Again, I can't promise that I'm going to make money. It's impossible to know that you're going to make money. Everything we do here is just trying to improve our odds. So find the way that works for investing for you, because you may not trade as often as I do, or you trade more often than I do. So how you invest and the way you want to invest and your level of risk is all going to change how you invest, where you look for your shares, and how long or at what point do you buy into those shares. But I encourage people to look at both technical and fundamental analysis to really get a good picture of if a stock is a good, if it's a healthy or a sick company, and if it's on a buy or sell signal.
Can I show my show and tell now?
No. Yes.
Yes, because they're going to answer a lot of their questions if they see that, if they see it.
Go for it.
So let me just show, but I don't want to cut you short. But I don't want to have them here too long.
No, I wanted to
I
show
can
them
do it
the
on Monday.
screener. I wanted to show them the screener. I got to show them the screener. I did my little dealy boppy. I'm happy.
And don't we have a link to the screener?
To the screener, I can post one.
Okay, the nata is the cream. I lived in a farm, all right, in Cuba, and they would milk the cows. And then the cream goes to the top. And then you get that cream, and that's what you make butter with. Well, when I say I got the nata out of my stocks, is that every day, especially when we had all those up and downs crazy days, when we had an up day, I would scoop up all of the nata, all of the profits, and I would sell them and keep my initial investment in there. Then if it went up again, I would scoop them again, and then I would sell them. So that's what I mean by that. So if I may now with Jonathan, great job, incredible. Aplauso para Jonathan. You do me proud. I want you to know the mamas here were texting me. You must be so proud. You must be so proud. Yes, of course I am. Okay. Some of you are putting in some files to download, and I'm afraid to download anything with all due respect to you. So I don't know what it is, so I'm not downloading it. But please put an explanation there of what you're doing. Has anybody downloaded any of the files?
I would not recommend downloading any files that you do not know what they
I
are.
wouldn't either, guys. I love you to pieces, but please don't just because somebody could be using that name and it's not even that person. Okay, we don't know, and I don't know. I am mientras más vieja, menos.
But
confianza.
I do want to say that we are interested if people have stuff they want to add. If you have links or anything like that, send them to tudineroconjulie@gmail.com, and I can look at them a little bit more in detail then. But for people just posting links in chat, I would avoid posting them, and furthermore, I would avoid downloading them.
I even asked one of you, what is it that you are trying to have people download? Because please, I hope you're not offended. I appreciate your wanting to share, but I need to protect all the rest of you too. Okay, so please don't download. Okay, now that I have big enemies, let me show you my stuff, and you're going to put cooties on it. You're going to put 2 on my stuff, and you better not, okay, because I'm making money, so you better not.
Also,
okay, let me show
we
you
are going to go over point figure a little bit more next week, so if you're confused on what double tops and triple tops and all that are, don't worry, we'll go over that.
Oh, yes.
I promise we're not going to leave you hanging.
Stuff.
We're not going to leave you hanging.
Let me show you something here. I go to stockcharts.com. Now, I pay for the subscription. I have never had a subscription until this year, which means it's like almost 20 years since I don't know if they've been around that long, but and this is what it allowed me to do. It allowed me to save my charts. And I put a list of charts for you. And today I went over a few of them after the morning show. And it's on Facebook if you want to see it there. But I have 24 charts there. But I want you to see okay, first of all, this is the summary of all of them. These are the companies that I own. Please, this is not a recommendation. Just because Julia La Loca has it doesn't mean you have to, but these are the companies that I have, and you'll see them twice there. I have Adobe, ASML Holdings, Bandwidth, DDOG, DocuSign, Johnson & Johnson, The Cubes, Corvo, Snap, Exxon, and Zoom. Okay? Those are the stocks I own. Now, let me go to the first. Let's see, hold on a second, because I'm still not very used to this. Okay, now I want to see, ¿qué es esto? My dashboard. Oh, chart list, there, okay. All right, and I'm going to go to, and just to show you that sometimes I break the rules, okay? This is more an art than a science many times. That little thing is driving me crazy. Let me close this one, and this one, and this one. Hopefully now it'll go faster. And hit it again. When in doubt, hit it 60 times. Views as 10 per page, okay. And I'll tell you when I bought it. Okay, the first one I'm showing you, that box will go away. I don't know what it is, but it'll get tired. There you go. Okay, the first chart that I came up with, that I did, was a bar chart, not a bar chart, open, high, low, and close. It shows you the left is the open price, the right is the close price. The long line is from the highest price that it got to the lowest price. I don't know what time it did. This is a daily chart, so each little line is one. Red ones is when it closed lower than it opened. Black ones is when it closed higher than it opened. And this one should be red. Anyways, this is today. I don't know when it hit 92.50. I don't know when it got up to over 95. All I know is that it opened here and it closed here. And it tells me here, it opened at 93.50. It went as high as 95.54, as low as 92.81, and it closed at 93.85. I put the 21-day moving average. Remember when we take the 21 days and we divide by 21, the last 21 prices, we divide by 21 and we plot it. This is the 50-day moving average. The reason that I'm using these two averages is that this first one should serve as a trampoline. I don't know how you say that in English. Trampoline?
Trampoline.
Thank you. Okay, so if you have a healthy stock, it's going to bounce up that level right there. Some stocks will go through that, but this is what the hippos are watching. They are watching the 50-day moving average. And most of them, when they hit that average, they decide if they're going to give them support or not. Here, they were using the 21-day. Look, the volume went up. You can see the volume here. Those are the hippos getting in. So, and here, once it went down, the 50-day moving average, look what the hippos did. They started selling. So these two lines are important because that's how they decide if they're going to back it up or not. The second chart that I asked for is the relative strength between that share and the S&P 500. Abby is doing 0.47 under the performance of the S&P 500 and is doing under 6.4 under the NASDAQ. But this also happens to be a drip. So I have three different, I have Johnson & Johnson, Exxon, and Abby as my drips. Then I have my crazy buys, okay? These I don't buy, but let me show you when I bought it. I bought this today. Then, can you see why I bought this today? What kind of a breakout is this? Rarely seen. Tell me through the chat. Give me some blood. I'm giving you blood, you give me blood. What is it called? Thank you, a quadruple. Who said that? All of you. Wonderful. It's a quadruple breakout. And I bought it today, and I bought it at 90. I'll tell you exactly how much I paid for it. And this is what I'm going to be going through by on Monday, is how to set up all this stuff, because this is how I keep track of it on my stock tracker. And I'm looking at my transaction log, and I bought Avi today, 94.02. I mean, did I get it right or did I get it right? No guarantee that it was going to go up, but I bought it. I know that I bought it at the right price. Why? Because it's an uptrend long-wise. Look at this. And because it gave me a buy signal here. If it had given me a buy signal here, I would not have bought it because it was in a downtrend. But when you have a stock that gives you a buy signal and it's in an uptrend, now I'm going to wait until it gives me another buy signal. I'm not going to chase it anymore, but it's going to correct sooner or later. Let's say that tomorrow it starts going into zeros. I hope not, because I don't have a lot of profit in there. I'm only making in fact, I'm losing 0.18% because it closed at 93.85, but after hours, it went down to 93.65, and I bought it at 94.02. So I am losing 0.18% on that stock. But if it now goes into zeros, when it goes up into excess again, how much is the next buy price? What's the next buy price if tomorrow goes down? Yes, 96, you're right. You're asking me about taxes. First of all, I have it inside my IRA. So when you have it inside an IRA, your buys and your sells, you don't pay taxes for it now. However, I don't ever want you to buy or sell because of taxes. The other one I used to say is buy or sell because of commissions. Now we don't pay commissions, so you don't have to worry about that. But I've seen so many people that have held on to their stocks waiting for the capital gain to be a long-term, and guess what? They didn't have to worry about it because by the time it was a long-term capital gain after the 12 months, they were losing money instead of making money. Don't wait. You sell at the right time, you buy at the right time. Put a happy face on the taxes. Those are the best problems to have. All right. So when you're making money, you don't mind sharing a little bit of that money, okay? But you need to work on making money. This company then went up to here. Now, you saw here that it bounced off, and today it did this. Let's see what happens tomorrow. Next one that I have is Adobe. Adobe I bought at $379.30. So I bought it back here. And let me show you on this one, it's easier to see. $379.30. I bought it here. I put a market buy right there at $376, but of course, because it's a market purchase, it buys at the next price. Sometimes it's more, sometimes it's less. And this time I lose, it was less. But at 379.3, I bought it now, well, I bought it back in May. I'm up 3.59%. Okay, next one. ASML. ASML, and I'm showing you this because it gives you such a good idea of when to buy it. ASML, I bought at 350.01. And I bought it, why did I buy it at 350.01? Además de porque me dio la gana. This was the buy price. I got in late because 32.80 plus 328 When I put my buy order, it was still within the 10%. So by the time I saw it, fine, I got it. No, sorry. ASML, I bought it at 344.12. Okay, so by the time I got it, it was already around here. I am up 3.81% in that. Now, bandwidth. Bandwidth, I bought at 115.02. It is now 115. I'm losing 0.02%. These are my most recent purchases. This one here, D-Dog. This was my sick child. This is my one sick child. I am down 2.97%. I bought it at 72.82. Right here. See 72? I bought it here. La muy condenada llegó hasta 73 y se echó para atrás. This is a stock that if it goes down to here, because it would break this, I would sell it at 67. And I have alerts here to let me know. Next one. These are not recommendations. These are, I put my hard-earned money into these, but I do not want you to think they're recommendations. But I need you to use it as, look at this. Is this a beautiful chart or what? It goes up, it goes down, it settles down, higher, settles down, goes higher, then down, higher, and now this time, this is DocuSign, guys. Today it did this. This is my other not so good child, but I am 1.26% up because I bought it at 137.90. I bought it here. DocuSign 137.90. Yeah, and it closed at 139.64. Okay, next. Johnson & Johnson. This is one that I'm not going to sell using any kind of story because I bought it at 145.62. This is my drip. 145.62. Where did I buy it? Back here sometime. And I'm holding on to this one. Now it's 239. No, now it's 140. I'm showing you QQQ. I'm showing you the wrong one. I bought QQQ at 222.57. Right here. I put my buy order here. Okay. And then it went up and then it went down a little bit. Then it went up again. And I'm up 7.69% in that stock. Next. Cuervo. Cuervo I bought a couple of days ago at 112.65. See here, by the time I put it in, it had gone to 112. The buy price was 1.6. I am up 2.68 on that one. And Snap. Snap I bought at 18.42. Here's 18.50. So here it went my favor. It went, I put the order when it hit 8.50, then I bought it at 18.42, but then it went up. So there in Snap, I am 10.37% above my buy. I think I own 11 or 12 stocks right now. Crazy, I've never done that. Okay. And this is Exxon, my baby. Okay, two really good things happen here. One is, well, besides the fact that they were paying 7% dividend when I bought it, and it's probably, and I really just, I don't know why. I did a lot of studies on Exxon, and I think their financials are so strong. I bought it at 46.19. See, the buy price was 47. It broke out a triple top. Not only that, but then it continued, and once it hit this down, depressing downer of a line, that line, it put a stop to it, And now the blue line, which is the uptrend, goes back to the lowest O that it had, and it makes a 45-degree line, always at 45 degrees, and now it's in an uptrend. So they have my vote. Let's see if, 1 second.
This may be a good place to call it, by the way.
Okay, no, that's it, because I think that that's it. One
If
more,
we
I might
didn't-
Zoom, but Zoom, look, I took Nata out of Zoom here because I bought it several times, and I took out money 3 times from Zoom. And the last time that I bought it like around here. Or the last time that I sold it. So I'm still ahead of what I sold it. In Zoom, I made, hold 1 second. Just giving you the percentages. In Zoom, I made 21.27%. Okay, so this is just so that you see in real life how things work. And I'm sorry to rush you through it, but I'm happy to take any one of them and break it down or show you more, but we need to be fresh in our brains to do that. So Monday we play. Monday I show you stuff on here and show you how to do some fun stuff. And okay, because today was heavy. You guys hung in there. Jonathan has smoke coming out of his ears.
Awesome. Well, thank you guys all for sticking through it. Again, if you have any questions that we couldn't answer today, please feel free to give us an email. Next week, we'll go over the stock screener, as well as I will go through point and figure so we can address everyone's questions about buy and sell signals for fundamental analysis or technical analysis. So
Okay,
you guys
Monday
all.
I'll explain to you about the nata and including how to make butter. All right.
And then these videos will be up on Facebook as well as YouTube. We now have a YouTube channel. So
Yes, please. It's called Tu Dinero con Julie. Julie Staff. It's the one with the picture with the yellow, with the pink Costco shirt and the bigote on. Because I had my mustache, you got milk. I did that.
And those will be up. Feel free to like, comment, and subscribe. Have a wonderful evening, guys.
Love you. Be safe.
Take care, everyone. Bye.
Save your questions.